My name is Thomas Key, and I am President and CEO of Stock Traders Daily. This is the third installment in our liquidity observations, and in this installment, I'm going to tell you what you need to do. This is very important. This is not a marketing video. It's not a 2-minute video that's meant to capture your attention. I'm going to give you very important information, and I'm going to tell you how to use it to make your life better, your investments better. We talked about fake money. We talked about stimulus. I'll go over them again for people that didn't get to see the first and second installments of this liquidity observation. But this one's focused on natural liquidity. As we compare that to fake money and we quantify the difference, we're going to take that information and use it to help us protect assets and also make money going forward. It's important to understand that anybody can use this information, so long as you're interested in getting a competitive advantage over the market. If you want to be ahead of the curve, then this information can be useful to you. Investment advisors can use it. Portfolio managers can use it. Analysts and investors can use it. Pension plans can use this information too, and so can board members who advise their companies on what to do with their money. If you want a competitive advantage, if you want to get ahead of what's going to happen in the market, this information is useful. It's also important to understand that liquidity impacts all assets, not just one. Yeah, my business is the stock market, so that's where my focus is. But liquidity impacts all asset classes. Liquidity is another word for money, right? So the amount of money going into stocks and bonds and real estate and private equity, because private equity invests in stocks, bonds, and real estate for the most part. The amount of money going into these assets matters. Liquidity matters to all asset classes. But my research is telling me that new money matters most. The money that's already invested into stocks can't be churned to cause growth in the stock market. For example, you can't churn the stimulus money that's already there and expect the stock market to increase. In order for prices to increase, we need new demand or new money. And that's incredibly important. It's incredibly important to separate new money from old money. But we also have to recognize that old money, or already invested money, can actually hurt the market when it comes out of the market, because it causes a drain in liquidity. But it can't help to foster price appreciation. Only new money can do that. And so it's very important for us to recognize new money individually. So with that, where's the new money? In the first couple of steps of this liquidity observation, I talked about that. It's not coming from central banks anymore, is it? No, they're actually draining liquidity from the financial system now, where they were infusing tons of money last year. I talked about that in the first step. And then I addressed corporate buybacks. And we're getting some new money from corporate buybacks. They're repurchasing assets faster this year than they have in a long time. But it's really marginal and largely focused on technology. Apple alone was 50% of the most recent corporate buyback announcements. And they're short-term in nature, almost always. But I also got another series of questions that popped up regularly about these central banks. The central banks, everyone seems to think, will just step in there and save the day again if something goes wrong. And I don't know the answer to that. They might. I don't think that they'd do it in the same way and buying as many assets as they did this last time. But if they did, it would require something devastating to happen to the economy anyway. So if you're relying on central banks to come and save the day, you're essentially telling yourself that you're willing to get a large haircut in the value of your assets before that happens. I don't think that makes any sense. Where's the new money right now? Well, in that step 1 article that I shared with you, the article that I wrote for MarketWatch, I talked about how the central banks are changing the liquidity flows into global assets. And it's happening at a time when valuation levels are excessive. In the second MarketWatch article, both of these are authored by me, of course, I shared with you the impact of corporate buybacks. And that, too, is important. And the combination of these is actually causing a crisis in liquidity to happen. Now, it's not happening right now. This is June 22nd of 2018. And the crisis in liquidity is not yet hitting. But it's coming. According to a schedule that's already been communicated to us by the central banks. And when that comes, it can get ugly. And that's what we're preparing for. In July, the central banks, according to their predefined schedules, will drain $70 billion per month from the global financial system. Last year, they were infusing $60 billion per month, and the stock market moved up in one direction without much volatility at all. In July, they will be removing more than they infused on a monthly basis last year. The difference is $130 billion. The liquidity picture from the central banks has turned on its head, and it happened in 9 short months. If you think that money matters, if you think that liquidity matters, this must matter to you. Because that was new money when they were infusing $60 billion per month, and now they're draining 70. And corporate buybacks won't make much of a difference at all when that starts to happen. But now, natural demand. Where does natural demand exist? First, natural demand is defined by the investment rate. The investment rate is a derivative demographic analysis that I created back in 2002 to identify the rate of change in the amount of new money available to be invested into the U.S. economy over extended periods of time, dating back to 1900 and looking out beyond 2062. The investment rate tells us how demand levels change using a natural observation rooted in what matters most to economies, and that's people, and the way we invest our money over time. And that, in turn, is rooted in ingrained societal norms. And if we measure that against long-term market and economic cycles, it measures up perfectly. Let's have a look. This is a chart of the investment rate. By the way, if you want details on it, I have all of those details at Stock Traders Daily. The investment rate has 3 major down periods since 1900. The first was an upward sloping cycle that ended in 1928. But between 1928 and 1938, there were fewer and fewer new dollars available to be invested into the U.S. economy. That made growth more difficult. By the way, that was also the Great Depression. The decline in the investment rate marked bookends of the Great Depression. The second down period was 1969 to 1981, bookends of stagflation. And the third major down period in U.S. history began in December of 2007, and it lasts until 2023. The investment rate tells us that natural demand levels are declining. And we are still in a downward sloping cycle based on natural demand. This should matter to you. This should matter to you because the investment rate tells you the amount of new money available for investments, which in turn identifies the demand for new investments in the stock market and into the economy, which in turn influence the things that matter to you most: your stocks, your mutual funds, your managed accounts, your real estate, and your private business. Money matters to all of these asset classes. The investment rate should matter to you as well, because it identifies the natural demand levels for these assets. In addition, it's important to recognize that demand was significantly skewed by stimulus. I created this quantification at the end of the FOMC stimulus program. They ended their bond buying program at the end of 2014, but didn't start removing assets from their balance sheet until recently. When they stopped their program, though, I quantified the difference between demand levels. Demand at that time was significantly higher than natural demand. And it was because they were infusing $60 billion per month into the system. It was more at times, less at times, but on average, that's what it was. And demand was about 66% higher than where natural demand actually was. Think of it like this. For every $100 of demand, only $44 of that was from natural sources. The rest of it was fake money. It's also important to recognize that when the fake money goes away, demand levels revert to natural demand. This is very important to recognize. But it didn't stop there, did it? Yeah, Ben Bernanke started the process, but the ECB picked up the pieces right away. They started a bond buying program in 2015, right after the FOMC stopped theirs. So the global economy has had this constant infusion of capital, even though the FOMC has actually not been buying bonds for a long time. Still, this combination was significant and very, very important. About $4 trillion got poured into the global economy during this time span with one intention in mind. They wanted to push asset prices higher, and they did it. The central banks pushed asset prices higher. It trickled down into everything. Yeah, it started with bonds, but the ECB was actually buying preferred stocks directly. And the correlation, and I'm happy to share this with you at Stock Traders Daily if you're interested in seeing it, the correlation between the timing of the decision of the ECB to start buying corporate bonds and the direction of the stock market, remarkable. Everything considered, they were aimed at increasing prices, at asset inflation, and they did it. It was successful. But now they've stopped and they're unwinding their program. And as they do it, those natural demand forces are going to prevail again. But there's an additional catalyst here that makes risks even higher than they otherwise would be. This old money that is the FOMC and and ECB balance sheet is now reversing itself. The monies are coming out of the financial system, and in a very aggressive way. In total, this year in 2018, $420 billion is expected to be ripped out of the liquidity in the global financial system. That's massive. It matters. And it can have a compounding influence on the reversion to natural demand as well. That can cause an undershoot in where we would otherwise be. And it's happening now. It's just about to change. The major drain starts in July. So here's some free advice pertaining directly to your 401k plan. And I think you should do this right now. Don't hesitate. Call the person in charge of your 401k and make a change. Move your 401k to the money market account. I'm not talking about selling your 401k. Don't do that. Just move it out of the mutual funds into the money market account that has no risk, that pays you 1% or whatever it pays you. Something minuscule that doesn't look attractive compared to what your small cap fund did last year. But it doesn't have any risk either. Take the money out of the mutual funds in your 401k, out of the stocks in your 401k, and put it into the money market account. And accept those small percentage returns and wait till the capitulation hits. It might take a couple of years, but at some point, the sky is going to be falling. And when that happens, that's when you want to reallocate. In the meantime, your 401k is not nimble. Very few of them are, at least. So your best place is in the money market account. Keep contributing to it. Keep getting the employer contribution, too. It's probably the best return on your money you're going to find in the coming years. But move the money to the money market account and don't worry about it. You'll be extremely happy if you do this. And for those of you who look for opportunities, look, this is a great opportunity. We can profit from this. We can make money from knowing what's going to happen in advance. And an opportunity like this is a great one. Just as much as these central banks told us what they were going to buy before they were going to buy it, how much they were going to buy, and when they were going to buy, during stimulus, which is ridiculous, they're telling us the same thing on the opposite side of the spectrum. We know where the drains are coming from, and we can take advantage of it. But you need to be objective, right? You can't be closed-minded here. If you are, though, you can do very well with this. And it is this type of environment that I specialize in. I started Stock Traders Daily in January of 2000 at the peak of the internet bubble. And if I wasn't proactive in managing risk, I would have had my head handed to me, just like everyone else did. I don't know of a single one of my peers back then that still is around today in the same way. I was born into being proactive, into managing risk. And I specialize in it. We thrived during the collapse after the internet bubble. We thrived during the credit crisis compared to the market. We did well when the market moved higher too, but when the market moved higher, it looked good too, so we didn't stand out as much. But our strategies are designed to work no matter what happens. That's the key. We're not going to sit there and short and plug our nose. That's not the objective. The objective is to be prudent, disciplined, and rules-based, and make money no matter what happens. That does something very interesting, because for those of you who think, well, liquidity, sure, it matters, but not this time. For whatever reason, you might draw that conclusion. I don't see how you can do that. $130 billion turnaround is massive as far as I'm concerned on a monthly basis. But if you're drawing that conclusion for some reason, the good news about the strategies that I offer is that these strategies can work even if the market goes higher. It's very, very important. And you can do this. And I encourage you to prove it to yourself. Start by looking at natural demand. Look at the investment rate. Look at the way it's derived. Look at the societal norms. Look at the derivative demographic data and draw the conclusions yourself. And if you like things like Fibonacci calculations, you're going to be amazed at how the golden sequence lines up with the growth identified by the investment rate. Quantify the difference between fake money and natural demand, and you'll see exactly what I mean. But don't stop there. Review the strategies first. I'm going to tell you to look at the strategic plan strategy at Stock Traders Daily first also. That's because this one beats the S&P 500 by 70% since January of 2009, the virtual low of the credit crisis. From there, the stock market almost went straight up. One of the best bull markets we've ever seen in history. But the strategic plan strategy beats it by 70% in a rules-based, disciplined, risk-controlled, proactive manner. And that strategy is also up about 25% year-to-date as of June 22nd of 2018. The Dow Jones Industrial Average was down about 1.5% over the same time frame. These strategies that are capable of working no matter what happens are starting to look great again. It's nice to have a strategy that can work if the market moves up or down. That's what we do. The best way to do that is to take a free trial at StockTradersDaily.com. If you do, I will give you a competitive advantage over this market. I will help you protect your assets or your client assets if you're an investment advisor. And I'll help you understand how you can make money from this environment. This is what I specialize in. But you need to look in order to learn. The good news is it's free. You can come in and look at what I do for free. You'll get the research, all of it, for free. You'll be able to watch the strategies work in real time and review all of their metrics for free. And you'll be able to walk away with an educated understanding of the environment we're facing today, and therefore be able to make educated decisions about what you should be doing as well. And if you like it, then pay me for it. I hope you'll like it. It's hard to debate the facts surrounding what these central banks have actually told us already about them draining liquidity. If you like it, pay me for it. But either way, you'll have a wealth of information and research that you didn't have before. I also encourage you to share this with other people. You know people who care about liquidity. You know people that would be hurt very bad if the liquidity drain hits this market really hard. And you know people that also need to protect themselves. And some that might even want to make money from this. Share this information with them too. Take a free trial at Stock Traders Daily. And I will share it all with you first. I look forward to seeing you there. Thank you very much.